So I'll reiterate what I've been saying for at least a year. I think it's a matter of time gold gets to $3,000 an ounce. It could meet the S&P 500 at that same level. It always has gone back to 1-to-1. And it's probably going to have some back and fill. I don't know how much lower it goes, but 2,200 is pretty good support. But the significance is gold has had a history of rallying when Treasury bond prices are rallying, meaning yields. So in terms of dollars. Now, if you're in a country that's debasing your currency, sure, gold's always going to be about currency debasement hedging. But in this case, I think those are the two best potentially performing market asset classes in the next few years as we head towards this global recession, which is clearly the case in commodities, and that is gold and U.S. Treasury long bonds.
Gold has captivated attention in 2024, with a strong rally to new highs in forecasts, suggesting it could surpass $3,000, as interest peaking in early August. Indeed, Finbold's research found that between July 31st and pre-market on August 6th, interest in the buy gold search term rocketed 63.93% from 61 to 100 on Google Trends. The figure is also substantially higher than at any other time during the period under review, which covers the 90 days between May 6th and August 6th, 2024. The surge in bullion investment interest likely stems from recession fears triggered by the FOMC meeting in late July and the jobs report on August 2nd. According to Mike McGlone, U.S. Treasuries and gold are predicted to be top-performing asset classes amid a looming global recession. Despite concerns about deficit spending, U.S. Treasuries yield higher than the top 5 international counterparts. Gold prices eased on Tuesday on dollar strength and higher bond yields, although expectations of a U.S. rate cut in September and escalating geopolitical tensions in the Middle East kept bullion stable following last session's sharp retreat. In the context of the current situation, McGlone predicts that gold and U.S. Treasury long bonds will excel as we enter a deflationary period following 2022's peak inflation. He foresees global economic issues and expects U.S. interest rate cuts and a potential rise in unemployment to 6%. From a technician's perspective, Mike McGlone explains that the market peaked in 2022 due to speculative futures trading and has since shifted towards individual commodities, especially industrial metals. Moving forward, he foresees continued deflationary pressures in commodities and equities, indicating a long overdue adjustment. Global commodity prices are leveling off after a steep descent that played a decisive role in whittling down overall inflation last year, which could make it harder for central banks to cut interest rates quickly, according to the World Bank's latest commodity markets outlook. The report also finds that a major outbreak of conflict in the Middle East could halt the inflationary decline over the past 2 years. Now we present the clips of Mike McGlone's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
So I'll reiterate what I've been saying for at least a year. I think it's a matter of time gold gets to $3,000 an ounce. It could meet the S&P 500 at that same level. It always has gone back to 1-to-1. And it's probably going to have some back and fill. I don't know how much lower it goes, but 2,200 is pretty good support. But the significance is gold has had a history of rallying when Treasury bond prices are rallying, meaning yields. So in terms of dollars. Now, if you're in a country that's debasing your currency, sure, gold's always going to be about currency debasement hedging. But in this case, I think those are the two best potentially performing market asset classes in the next few years as we head towards this global recession, which is clearly the case in commodities, and that is gold and U.S. Treasury long bonds. Here's one thing I published recently, Jeremy. A few months ago, I pointed out if you take the average of the top 5 countries in the world outside the U.S., including India, the average of their 10-year note yields just recently reached 100 basis points below the U.S. Treasuries. U.S. Treasuries were that high. Now the U.S. Treasuries are catching up. Typically, U.S. Treasuries yield a lot less than the rest of the world. And so to me, that's what's happening. That's why I think Treasuries are still the place to be, despite people talking about deficit spending. Now, that's a bit of a problem, but it's deflation and inflation that matters, and commodities, certainly industrial metals, are showing us clear deflationary forces. And if we just get more backup in beta, that's just normal deflation, reciprocal to significant inflation on the back of the biggest money pump in history to the peak in 2022. I think there's times to be underweight risk assets and overweight risk off assets. And I think in the next few years, some of the best performing assets will be gold and U.S. Treasury long bonds as we tilt towards a deflationary period reciprocal to inflation that we got to the peak in 2022. It's happening globally. Keep an eye on China. It's happening in Europe. We see issues in Canada. The question is what stops at this juncture. We will see cuts in U.S. interest rates, and they're still pretty high. But I'll end with this. The U.S. unemployment rate, it's 4.2%, 4.2 or 4.3%, bottom last year at 3.4%. It's never bottomed that low without going to 6%. And that's just 100% probability since 1947. I suspect that might work. We'll see how different it is this time. When the market pumped up to the peak in 2022 and then fell to where it is now, it was a commodity market. Now we're switching back to a market of individual commodities. And crude oil was a great example. What drives these futures markets are speculative futures. Managed money, managed money net positions in futures are good indicators. So petroleum futures got way too long at that peak early in the year in the 80s, and then got sold out completely as we flushed down to 69 or so in WTI. So they're basically sold out. So crude oil is basically somewhat flat in terms of managed money net positions. But what the key thing was this year was copper. That copper high, 5.20 cents, was almost completely driven by pretty significant massive buying in speculative futures. They got to the highest level in about 4 or 5 years as a percentage of open interest, over 32%, and that's CME and LME, and now they're still getting flushed out. But the problem is, typically these bottoms in copper come when the positions get flushed out to maybe 5% open interest, and there's still 20% of open net long, so they're getting stopped out. And so that's where you really see that. You definitely see it in the grains. The grains are the best leading indicator because they have the highest elasticity supply and prices. And the grains have been way sold out all year. Massive short positions. Why? Because it's in a significant bear market. Why? Because there's massive supply. And the main reason was because of the big pumps in prices. So it's that autocorrelation factor that's kicking in commodities. You can see that in managed money net positions. It's trickling down the equities now. And the bottom line is commodities are showing us deflation. Cryptos, I think, are signaling there might be more of that. And if we just have a little bit of more back and fill in the stock market, that's pretty severe deflation. That is pretty much overdue if you look at the lessons of history.
During the interview, Mike McGlone indicated that current market volatility is a normal correction, with the S&P 500 well above its 200-day moving average. He predicts Bitcoin's decline signals broader adjustments and advises against buying the dip. Consequently, he is optimistic about gold's prospects, noting it could perform well despite short-term setbacks. Gold has performed remarkably well in 2024, rising by 12% year-to-date and outpacing most major asset classes. Thus far, gold has benefited from continued central bank buying, Asian investment flows, resilient consumer demand, and a steady drumbeat of geopolitical uncertainty. Despite short-term volatility, McGlone expects gold to outperform, especially with rising ETF inflows and long-term demand. He anticipates that as gold, Bitcoin, and the S&P 500 face downward pressure, gold will emerge stronger due to its role as a store of value. Let's get back to the interview.
First of all, it's not so much what's driving the panic. This is normal mean reversion at the moment. The S&P 500 at about, as we speak, 5,200 is well above its 200-day moving average at 5,000. So there's still a lot of room for it to just catch up. It's just an example of what typically happens in markets is the most powerful force is mean reversion. Markets just got way too expensive. Then we saw kind of the plunge in the yen carry trade, the give back of all that liquidity there. But I think to me, the best leading indicators for all this has been Bitcoin. It trades 24/7. It's massive speculation. It has very high volatility. It started breaking down on Saturday, then Sunday. It should have told you what's going on. But to me, this is just the beginning of a normal market correction. And when you hear everybody say buy the dip with the S&P 500 still well above its 200-day moving average, ignore them and let markets work. But we might have some short-term bounces. In fact, we should. The Fed is going to ease. I mean, they are way above the rates of inflation in this country. But to me, it's the macros I pointed out earlier. We have just a long-term example of risk assets getting way too expensive. Cryptos were a good example of that. I think gold's going to come out ahead. Now, it's getting a little bit hit today, but it did begin in 2008. But there's some key differences that I think are more supportive for gold this time than last time. That's a key thing now. If you overlay like a 200-day moving average of gold, Bitcoin, and the S&P 500, they're all heading straight up. And one of them's going to, I think only one's going to win out of that. And I fully expect 200-day moving average to tilt lower in Bitcoin, to tilt lower in the S&P 500 as they tilt lower. But gold has one key difference, is it is a store of value, and it's been breaking up for a while, and the deepest pockets on the planet are buying gold. Also, what just happened recently is that we've had a 2-year downtrend in ETF flows. It's just starting to turn upward. So one thing that's holding gold back right now, it's pressuring it right now, is managed money futures positions are pretty stretched long for a bull market. They're getting stopped out. It's one of those environments. It's not a want to sell. It's a got to sell. You sell what you can. And that's happening in gold and Bitcoin. But gold's going to come out of this ahead because is a percentage of, compared to ETFs, are much more significant than futures were back in 2008 when gold went to 1,000, it dropped to 700, and then it started to move all the way up to 1,900. So I think this is a normal reaction, but the bigger picture problem is beta. It's a U.S. stock market, S&P 500. It's way overdue for maybe a bear market, a normal correction. And right now we're at the stage of a normal back and fill. And I think people should be very careful when people say buy the dip, when markets, it hasn't even touched its 200-day moving average. And I just mentioned a few weeks ago, it was the most above its 100-week moving average in almost 2 decades, with the exception of the big money pump from COVID. So to me, normal reversion, and commodities predicted this. The S&P, I'll end with this. The S&P, the Bloomberg Industrial Metals Spot Index was its peak earlier in there. It was up 24%, and it dropped to down on the year just a few weeks ago. It was telling you there's something wrong.
Gold and U.S. Treasuries are also viewed as safe haven investments. That's one reason gold becomes more attractive as interest rates fall on government debt. However, this raises questions about whether some of the buying in gold could be due to worries about a recession. How do you think economic shifts will impact the future performance of gold and Treasury bonds? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.